Welcome to this explainer. Today we are going to break down a mathematically proven step-by-step blueprint for allocating your money and actually building long-term wealth. You know, it drives me absolutely crazy watching people throw cash at the stock market like they're feeding coins into a Vegas slot machine, just completely ignoring the fundamental steps of wealth building. Today, we're not throwing dollars at whatever sounds exciting online. Instead, we're going to literally construct a rock-solid financial house from the ground up. But first, we gotta look at a pretty shocking reality. According to recent data, 1 in 3 Americans doesn't even have a basic emergency fund. In fact, the median amount Americans have saved for emergencies right now is a whopping $500. Think about that for a second. That's literally less than most people's monthly car payment, and it's actually dropped from $600 just a year ago. But here's where it gets wild. These exact same people are constantly asking about buying individual stocks or throwing cash into crypto, all while carrying credit card debt that charges a staggering 22% average interest. Seriously, it's kind of like asking if you should finance a Ferrari when you don't even have the cash to fix a busted transmission in your daily driver. It just doesn't make sense. So to fix this, we're going to dive into the optimal sequence for constructing your financial house across 5 distinct phases: the leaky bucket problem, pouring the foundation, free money and tax shields, the secret weapon, and finally, finishing your financial house. All right, let's jump straight into phase 1, the leaky bucket problem, and why the exact order of your money moves matters so much. Imagine you're building a grand new house. You obviously wouldn't start by picking out fancy light fixtures and expensive granite countertops if your foundation was cracked and the roof was caving in, right? Yet that is exactly what most people do with their finances. Getting hyped up about the latest trendy ETF while you're still carrying high-interest debt guarantees that any potential gains you make are completely wiped out by interest payments. You're essentially trying to fill a bucket that has massive holes in the bottom, and then scratching your head wondering why you aren't making any progress. The opportunity cost here is just massive. Every single month you delay paying off that 22% credit card debt is another month that debt grows faster than almost any investment return you could reasonably expect. Which brings us right to phase 2, pouring the foundation by tackling emergencies and debt. You simply cannot build a house on quicksand. So our very first real construction step is securing a psychological safety net. Before you invest a single dollar anywhere, you absolutely need an emergency fund. Because when life happens, and your car inevitably breaks down, having this cash means you don't have to sell your investments at a loss or rack up more toxic debt just to cover it. Now, you always hear that traditional advice telling you to save 3 to 6 months of expenses. But honestly, that number is so huge for most beginners, it's almost paralyzing. So instead, break it down. Start by scrapping together your first $1,000 as fast as humanly possible. Then work toward 1 month of living expenses, and finally hit that 3-month mark. And the data totally backs this up. Recent Vanguard research found that people with just $2,000 in emergency savings had financial well-being scores 21% higher than those without it. That's a massive boost in peace of mind from a very achievable number. Once you've got that safety net, we have to eliminate financial cancer by aggressively tackling any debt over 8%. Trying to invest while carrying 22% credit card debt is literally like trying to run a marathon with a backpack full of rocks. Mathematically, paying off that debt gives you a guaranteed return equal to the interest rate. And this brings up a huge debate: the debt avalanche versus the debt snowball. Now, the snowball method, where you pay the smallest balances first, is great for quick psychological wins. But if we're talking pure math, the avalanche method, where you throw every extra dollar at the debt with the highest interest rate, absolutely crushes it and will save you the most money in the long run. Okay, foundation poured. Let's move up to phase 3, free money and tax shields, specifically looking at the employer match and IRAs. Now that we're framing the house, we're entering the tax optimization zone. And I need to point out one massive exception to the rule about paying off high-interest debt first. You must capture your full employer match. This is essentially a guaranteed 100% immediate return on your money. Even if you have credit card debt, taking a guaranteed 100% return is a no-brainer. It's literally like finding cash on the ground that your boss promises to double if you just pick it up. The play here is simple. Contribute just enough to your 401k to get that maximum match, and then immediately redirect all your extra cash flow back to killing that high-interest debt. Once that toxic debt is gone and your match is locked in, you actually want to pivot. Redirect your investment money into an individual retirement account, or IRA, before you put another dime into your employer's 401k. Why? Well, an IRA gives you total control over what you invest in, and it usually comes with way lower fees. Corporate 401k plans are notorious for pushing expensive mutual funds with management fees that slowly eat away at your returns like termites in the walls of your new house. Over a few decades, dodging those 1 to 2% 401k fees by using low-cost index funds in your own IRA can literally save you tens of thousands of dollars. Now, when setting up that IRA, you're going to face a huge decision between traditional and Roth accounts, and this choice can seriously make or break your retirement wealth. It all boils down to one question. Do you want to pay Uncle Sam now or later? Generally speaking, you want to lean toward a Roth if you're younger or currently in a lower tax bracket. You pay the taxes up front today, but then every single dollar you withdraw in retirement is 100% tax-free. On the flip side, if you're a high earner right now at the peak of your career, a traditional account lets you deduct those contributions today, and you just pay taxes later when you'll presumably be in a lower bracket. And hey, if you're totally unsure, splitting your money between the two is a great way to get some tax diversification. Let's transition to phase 4. And honestly, this might be my favorite step. The ultimate secret weapon, the health savings account. If you have access to a high-deductible health plan with an HSA, this is where things get incredibly powerful. The HSA acts like the impenetrable steel vault of your financial house. It's the Swiss Army knife of investing because it packs a triple tax advantage. Check this out. You get a tax deduction when you put the money in, the money grows completely tax-free while it's invested, and when you pull it out for qualified medical expenses, that's tax-free too. It is literally the only account in existence that gives you tax benefits on the way in, during growth, and on the way out. The pro move here is to pay for your current medical expenses out of pocket if you can afford it, save your receipts, and let that HSA money aggressively grow. If you maximize this account for 30 years at just a 7% return, you could be sitting on over $400,000 completely tax-free for healthcare and retirement. Finally, we reach phase 5, finishing your financial house by maxing the 401k and opening taxable accounts. To put the roof on our financial house, we go back and max out the rest of that employer 401k up to the annual limit. By utilizing your IRA, your HSA, and your 401k, you are shielding a massive amount of your wealth from the IRS so it can actually compound properly. Once you've checked all those boxes, you finally graduate to the Wild West of investing, taxable accounts. In a taxable account, there are no contribution limits and no withdrawal penalties. You can buy individual stocks, options, index funds, whatever you want. It's ultimate flexibility, which makes it perfect if you want to retire early or save up a massive down payment for real estate. But, and this is a really big but, you have to watch out for tax drag. Every single time a dividend pays out or you sell a stock for a profit, the IRS takes their cut. It's exactly like trying to run a race while someone continuously dumps sand into your shoes. Let's put some actual numbers to this strategy to show you why order matters so much. Imagine investing $10,000 a year for 30 years. In a tax-advantaged account like your IRA or 401k, earning a 7% return, you'd end up with about $944,000. But if you did the exact same thing in a taxable account, getting the exact same return, but paying taxes on those dividends and capital gains along the way, you'd end up with closer to $700,000. Over 30 years, that tax drag creates a nearly $250,000 gap in your final net worth. This is exactly why taxable accounts are the very last step in our blueprint. So, there you have it. Following this optimal, honestly kind of boring but effective order is how you build real multi-generational wealth. Emergency fund, kill the high-interest debt, grab the employer match, max the IRA, optimize the HSA, finish the 401k, and finally spill over into taxable accounts. This blueprint sets you up for a financial reality most people can only dream of, all while everyone else is still gambling on the next hot stock. So I'll leave you with this to think about. Is your financial house currently sitting on quicksand? Or are you finally ready to stop filling a leaky bucket and pour your rock-solid foundation today?